Hello, everyone. My name's Aaron Petroff, and I'm the founder of Living Legacy. Today, I'll be hosting the next installment of our micro-planning series. The topic of today's discussion is the methodology for managing cash flow. One of my passions is teaching effective financial decision-making. There's a field of study known as behavioral economics, and in that field, there's emerging evidence that financial knowledge and financial confidence are linked to financial decision-making. It's my intention for today to teach a new technique for managing your cash flow that will give you greater knowledge and confidence, thus enhancing your financial decision-making. All right, the clock's ticking. Let's get started. The best place to start is by first identifying the challenges to managing one's cash flow. And one of the biggest problems is that most online budgeting tools are really expense tracking tools. And while it's helpful to track and know where your money went, there's a big difference between looking in the rearview mirror at what happened in the past versus having a forward-looking approach to managing your money. The next challenge is that traditional budgeting commingles fixed and variable expenses. And if you don't know what your fixed expenses amount to or what they total to on a monthly basis, it's really difficult to make decisions about your discretionary spending. The third bullet point is that we all get paid on a wide variety of pay frequencies. And this makes it really hard to match up our monthly inflows with our monthly outflows. The next item speaks to the distinction of identifying what is truly savings for the long term and what is being temporarily saved for a large future purchase. And then the final challenge on our list is that as technology improves, we're becoming a more paperless and cashless society. So if you don't have any statements to reconcile, no receipts to track, no canceled checks to keep track of or record in your register, then this leads to an overall lack of clarity about where your money goes. Further, going back to that behavioral economics I spoke to a moment ago, there's also emerging evidence that by removing the physical act of spending money, i.e. not taking it out of your wallet, the cash out of your wallet, or not physically writing a check, we're prone to spend much more money than we otherwise would. All of these things together conspire to have our cash flow be disorganized. And for many people, this creates anxiety, but most importantly, results in undersaving for retirement. So we're going to go through the solutions first, and then what I'm going to do is I'm going to share with you how to put these into practice. The first item on the solutions list is to have an intentional plan for where your money's going to go rather than simply having an after-the-fact report of where your money was spent. I don't like the term budget, as this tends to feel like a restrictive diet, which no one likes, and it doesn't really capture the essence of what we're looking to accomplish. Nevertheless, it's absolutely critical to have a plan for your money. The next item on the list of solutions is that you've got to convert all of your income and expenses into a monthly number. This is the only way to keep it all straight. Third, this one's an oldie but a goodie, and it's absolutely true. You got to pay yourself first. And what I've discovered over all the years working with clients is that if you make your savings automatic, you very quickly forget about it. And then what occurs is that all of your spending falls into alignment with your savings, as opposed to what most people do, which is the other way around. These last three bullet points all go together, and they relate to fixed versus variable expenses. The first thing that you've got to do is you've got to separate your fixed from your variable expenses. Next, you've got to solve for what's available for variable spending. The way that you do that is you total up your fixed expenses, you subtract those from that amount from your income, and then what's left is the amount available for variable spending. And of course, once you know what you have available, now you've got to manage your variable spending. And you've got to do this in such a way so that you stay within your cash flow limitations. All right, so these are the solutions. What I'd like you to do now is to get that note-taking material ready, because we're going to build a model. And what I'd like for you to do is I'd like for you to sketch this model on your paper as we create it on the screen. And the first thing that I'd like you to do is write net income in the top center. This is all of your monthly household income before any deductions. Include all sources: salary, bonuses, child support, regular gifts that you receive, anything and everything. If you're a business owner, then include the salary you receive from your business, as well as any draws or other distributions. The next item to write down is long-term savings. Long-term savings is any money being set aside for the far future. Think of this as your retirement savings. This is the money that will ultimately replace your paycheck. Here, you're going to include any monthly contributions to savings accounts, investment accounts, and retirement plans. In fact, include anything that's designated for the long term. However, do not include money being saved to make a future purchase that will occur in the near to intermediate term. That will be captured elsewhere on the model. Next, write fixed expenses. A fixed expense is predictable in terms of both the amount and the timing. Fixed expenses are not always monthly, but just like with everything else, you've got to convert it to a monthly number. Some examples of fixed expenses are rent, mortgage payment, car payment, property taxes, and auto insurance payment. The next item to write down is variable spending. This is spending that is unpredictable in both the timing and the amount. It's further divided into three subcategories. The first subcategory is save to spend. So save to spend is for expenses that are so large that you need to save up for them. For example, maybe you're going to take a vacation next year. Determine how much money you want to spend on the vacation, divide by 12 to convert to a monthly amount, and then save that amount in advance of the vacation. Likewise, let's say that you're going to make a home improvement in a couple years. Set aside money on a regular basis to pay for that home improvement. And just like with the vacation, you want to avoid putting this on a credit card and paying for it after the fact. It's prudent and in fact highly recommended that you save money for these future purchases. The distinction though is that it doesn't get included in your long-term savings rate. A lot of people get tripped up on this. And because if you include it in your long-term savings rate, what you're doing is inflating the amount of money that you're saving for retirement. It's not giving you a clear picture. The next item is allocated spending. These are generally small expenses that occur regularly, meaning they're somewhat predictable, but the amounts can and do change from month to month. Some examples are your electric bill, which may fluctuate with the season, groceries, clothing, dining out, entertainment, and hobbies. And then the final category is unallocated cash flow. This is simply cash flow that you haven't made a conscious decision on what to do with. It represents a huge opportunity. And what I've discovered over all these years working with hundreds of clients is that money that's not intentionally allocated will almost always be spent on impulse purchases or in other ways that don't further your objectives. In addition, it's been my experience that most people have a lot of unallocated cash flow. If you're not saving appropriately, then this is probably the best place to find extra savings. Okay, this completes the model. So what are the key discoveries and benefits from organizing your cash flow this way? First, it's okay to track your money, but it's absolutely critical to have an intentional savings and spending plan so that you know in advance where your money is going. Next, by thinking of your expenses in terms of fixed versus variable expenses, it allows you to drill down and identify the unallocated cash flow. And oftentimes, the unallocated cash flow is where the greatest opportunity exists to increase your savings rate. In terms of benefits, you'll find that by being intentional about the deployment of your cash flow rather than reactive, you'll have a much greater sense of control and confidence. The importance of this cannot be overstated. By being in control of your own journey, you'll be able to avoid the anxiety and even the shame that oftentimes accompanies the day-to-day choices we make while managing our finances. And finally, it should just be easier to save money for retirement, which is something that almost everybody on the planet is concerned about. This concludes the formal part of our presentation today. At Living Legacy, we help people solve complex problems with simple solutions. What we accomplish with our clients is listed on the screen in front of you. With respect to the technique for managing your cash flow that we discussed today, we have a special software tool that we use that organizes money consistent with what you learned. We make this available to all of our clients as part of our service, but we'd like to offer this to everybody who attended today, even if you're not a client, on a complimentary basis. So we'll send out a post-webinar email. If you're interested in getting the software, just respond to us on that. Or if you want to learn anything else about any of our other services, just mention it in the email and we'll get in touch with you. All righty. It's great to see you again. Have a good rest of your week, and I'll see you soon. Bye-bye.